The adjuster didn't raise his voice. That was the thing about it. He stood at the edge of the field, clipboard in hand, and said it the way a man reads a utility meter: flat, procedural, final. The farm did not qualify, not because the crops hadn't failed. They had. Corn was curling in the rows behind him, brown at the tips, barely knee-high in late July when it should have been shoulder-high and tasseling. The denial wasn't personal. It was technical. And in 1983, technical denials were ending farms across the Midwest at a rate nobody wanted to count out loud. Raymond Aldicott had been farming his 340 acres in central Illinois for 19 years at that point. He'd inherited the operation from his father-in-law, expanded it slowly, borrowed against it carefully. He ran a tight ledger. He wasn't the kind of farmer who over-leveraged during the boom years of the late 70s when land values were climbing and credit was loose. He hadn't mortgaged the farmhouse to buy a new combine. That discipline had kept him out of the worst of it, until the drought. The 1983 growing season was not a simple dry spell. It was a systemic failure of the entire central corn belt at a moment when the economics of farming were already fractured. Interest rates were punishing. Land values that had peaked around 1981 were deflating rapidly. Banks that had extended generous agricultural loans during the expansion era were now calling in collateral assessments. The drought arrived on top of all of that like a final weight on a structure already stressed to its limits. Yields in the hardest-hit counties dropped by 40, 50, sometimes 60%. Livestock operations couldn't source feed at any price that made sense. Grain elevators that had been holding contracts were renegotiating. The insurance system, federal crop insurance programs supplemented by private carriers, had become, for many farms, the difference between one more year and a foreclosure notice. Raymond's policy was through a private carrier, structured around yield history and acreage certification. When the adjuster completed his assessment, the denial came down to two connected factors. First, Raymond's historical yield data showed variability that the carrier's actuarial model flagged as inconsistent. A couple of strong years, a couple of weak ones, which lowered his baseline yield calculation and therefore his theoretical loss threshold. Second, and more damaging, the policy contained a clause related to irrigation capacity. The carrier's position was that without modern documented irrigation infrastructure, pivot systems, licensed well capacity, the farm's baseline assumed dryland production standards. Under dryland assumptions, the 1983 yields, while poor, didn't technically breach the threshold required to trigger the payout. The adjuster explained this without apology. It wasn't about whether the crops had failed. It was about whether the policy, as written, covered that level of failure under those assumptions. It didn't. Raymond stood in the field and said very little. He asked one question: could he appeal? The adjuster said yes, there was an appeals process. He gave him the paperwork. That appeal would go nowhere for reasons that had nothing to do with bad faith. The carrier's position was legally defensible. Raymond knew it. His attorney knew it. The policy language was clear enough that contesting it would cost more in legal fees than any realistic settlement would produce. The appeal became a formality, filed and quietly withdrawn 6 weeks later. What it did do was buy Raymond a month of emotional certainty, the belief that something could still be reversed before the reality reasserted itself. In 1983, false hope was its own kind of resource. It kept a man moving when moving was all that was left. The community response was what Raymond would remember longer than the denial itself. Not cruelty, most people weren't cruel about it, but a particular kind of quiet sympathy that functions as a social verdict. Neighbors who knew the situation would nod at him at the co-op or the grain elevator with that specific expression that means they've already categorized you among the ones who aren't going to make it. His wife heard it from the women at church. His oldest son heard a version of it at school. The Aldecott farm was in trouble. That was the consensus. And consensus in a small agricultural county in 1983 had a tendency to become self-fulfilling because it shaped what the bank was willing to do, what suppliers would extend on credit, what buyers would offer when they sensed desperation. It was that pressure, not anger, not defiance, just the cold arithmetic of needing to find something, that sent Raymond into the county records office on a Thursday afternoon in late August. He wasn't entirely sure what he was looking for. He knew the farm's legal description, its survey boundaries, its easements. But something his father-in-law had mentioned once, years ago, stuck in his mind. Something about the creek. Donahue Creek ran along the eastern edge of the property for about a quarter mile before cutting southeast toward the neighboring Harwell parcel. It wasn't much of a creek. In dry years, it ran low. In wet years, it flooded its banks briefly before settling back. Raymond had always thought of it as a drainage feature, more than anything else. A liability in flood years, a nuisance otherwise. But his father-in-law had said something once about rights, about papers, about something that had been filed a long time ago when the property was first developed for agriculture in the early part of the century. The records office clerk, a woman named Pauline who had worked there for 23 years, helped him trace the chain of title back through the abstracted deed history. It took most of the afternoon. What they found, filed in 1921 and again modified in 1934, were diversion rights, senior diversion rights attached to the land deed itself, granting the property holder the right to divert water from Donahue Creek for agricultural irrigation purposes up to a specified flow rate during the growing season. These weren't well permits. They weren't modern licensed withdrawals. They were riparian diversion rights with a priority date of 1921, which in Illinois water law made them among the oldest active claims on that creek's flow. Raymond sat in the records office for a long time after Pauline placed the documents in front of him. He wasn't a lawyer. He understood enough land law to know that what he was looking at was significant, but not enough to know exactly how significant. He had the copies made. He drove home. He called his attorney that evening. The attorney's reaction was careful, not celebratory. Senior diversion rights, she explained, were real property interests. They conveyed with the deed and were legally binding on downstream users. But their value in 1983 depended on two things. First, whether the physical infrastructure to exercise the right still existed or could be restored, and second, whether the water table in Donahue Creek was sufficient to support diversion during a drought year. The right was real. Using it was a separate question. She also flagged a third issue quietly. Diversion rights don't eliminate the limits of what the creek actually carries. If Raymond diverted water at maximum permitted levels during a drought, he might find himself in conflict with other users downstream, particularly if they had their own claims or if his diversion affected established uses further along the waterway. That was a problem for later. The immediate question was the infrastructure. Raymond walked the eastern boundary of his property the following morning. He found what he was looking for about 200 yards north of the property's southeastern corner, the remnants of a diversion headgate structure, mostly buried under decades of silt, brush, and collapsed timber. It had last been operational sometime in the 1940s, based on what the records suggested. The original channel that would have carried diverted water into the farm's eastern field sections had been partially filled in, probably deliberately at some point, when the farm switched to dry land production, and the infrastructure became more trouble than it was worth. What remained was a legal right attached to a dormant physical asset. The repair estimate came in at just under $4,000 for a basic functional restoration, excavating the channel, rebuilding the head gate with materials that would hold for a season, getting the diversion operational at limited capacity. Raymond's bank balance at that point was not comfortable, but it was not zero. He had avoided the worst of the over-leverage. He had equity. He made the decision without drama. He hired 2 men with a backhoe and spent the next 3 weeks overseeing the most important construction project of his farming life. In the second week of that project, a storm came through. Not a severe storm. Nothing that would have made the papers. But enough wind and water to raise concerns about the partially excavated channel and the temporary berms they'd constructed around the worksite. Raymond spent a night watching water levels in the creek from the field edge, genuinely uncertain whether 3 weeks of work was about to wash out. It didn't. But the margin was close enough that he understood clearly how fragile the whole project was. One bad storm at the wrong moment, and the math changed entirely. The head gate went operational in early September. By that point, the corn that would have been the primary cash crop was already lost. The season was too far gone to save the main fields. What Raymond could irrigate was a smaller section of late-season soybeans and a portion of his dryland winter wheat ground that he was preparing for fall planting. It wasn't salvation, it was position. He was establishing at real cost and real risk the ability to move water from the creek into his eastern fields. He was doing this in a drought year when every farm around him was entirely dependent on whatever rainfall came. The water question complicated immediately, as his attorney had warned it might. A downstream property owner named Gerald Fenwick contacted Raymond in late September with a letter from his own attorney claiming that Raymond's diversion was reducing flow at a point where Fenwick's operation drew water for livestock. The letter was not a lawsuit. It was a warning and an inquiry. Fenwick's attorney asked for documentation of Raymond's diversion rights and an accounting of the volumes being diverted. Raymond's attorney responded with the 1921 filing and the 1934 modification. The priority date mattered here. Raymond's rights were senior to anything Fenwick could claim. But the practical resolution required a negotiation, because Fenwick's livestock operation had real needs, and a legal fight over creek water in a drought year would benefit no one. The settlement they reached was a diversion schedule. Raymond would operate the head gate during specific morning hours, which allowed adequate downstream flow recovery before Fenwick's peak livestock watering periods. It wasn't perfect for either party. It was workable. Raymond got reliable access to water during the hours that mattered most for irrigation pressure. Fenwick got protection against a total disruption of his operation. The agreement was written, signed, and filed. It was also, though neither man fully understood this at the time, the beginning of a water access framework that would prove more durable than either of their insurance policies. The second drought wave hit in the following spring and extended into the 1984 growing season. This is the part of the story that most people outside agricultural communities don't fully account for. 1983 was not an isolated event. It was the most severe year of a multi-year pressure system that ground through the farm crisis across multiple growing seasons. Farms that had survived 1983 on emergency credit and deferred payments found themselves facing the same conditions the following year, with even thinner margins. Raymond's position in 1984 was materially different from 1983 in one specific way. He had a functioning diversion system. He understood its limits, the flow rate it could realistically deliver, the sections of his operation it could irrigate cost-effectively, the scheduling constraints imposed by the Fenwick Agreement. He wasn't able to irrigate his full acreage. He wasn't running a modern center pivot operation. What he had was targeted water access to roughly 80 acres of his eastern fields during a year when virtually no one else in the county had any water access at all. His 1984 corn yield on those 80 irrigated acres came in at 63 bushels per acre. The county average that year was under 30. He wasn't producing record crops, he was producing crops at all. And in a market that was experiencing genuine scarcity, the premium that buyers would pay for assured delivery was real and measurable. He sold that corn at prices that reflected the supply compression. He didn't need record bushels. He needed margin above his cost of production, while his neighbors were selling at or below their cost of production. It's worth pausing here to say something about what insurance actually does and doesn't do in a farming operation. Policy covers documented loss against a historical baseline. It compensates for what didn't happen compared to what was expected to happen. What it doesn't do, what it structurally cannot do, is create the capacity to produce when conditions collapse. A payout in 1983 would have given Raymond liquidity. It would not have given him water. The insurance company, in denying his claim, had not taken anything from him that could have grown crops. They had denied him a financial cushion. The distinction mattered because Raymond, in searching for what the policy couldn't give him, found something the policy had never considered. It wasn't about the claim, it was about control. By 1985 and 1986, the foreclosure wave that had been building through the farm crisis was cresting. Farms that had held on through 1983 and 1984 on borrowed time were running out of that time. The banks were processing what the market conditions had been building toward for 3 years. In Raymond's County, 14 farm properties went through foreclosure auction between 1985 and 1987. Raymond attended several of those auctions. Not all of them, he didn't have unlimited capital, but he had something most of his neighbors didn't. A track record of producing yields during drought years, a functioning water infrastructure, and a bank that had watched him make his payments while everyone around him defaulted. He acquired 2 adjacent parcels through those auctions, totaling about 190 acres. Neither purchase was cheap in absolute terms, but both came at prices well below what comparable land had sold for at peak values in 1980 and 1981. More importantly, one of those parcels included a section of Donahue Creek's upper reach, which meant Raymond's control over his own water source became structurally more secure. The water rights he held downstream were now backstopped by partial ownership of the upstream channel. The legal complexity of that position took his attorney another 6 months to fully document and protect. During this period, a neighbor named Carl Brester made an accusation at a township meeting that Raymond was using the diversion to take more water than his rights permitted, essentially draining the creek for his own benefit while other operations suffered. The accusation got local traction briefly because it fit a narrative people wanted. The one farm that was surviving must be doing something at someone else's expense. Raymond's attorney produced the flow documentation they'd been maintaining since the Fenwick settlement. The diversion volumes were within permitted limits. They had records to prove it. The accusation died in about 3 weeks, but it illustrated something that mattered. In a resource crisis, visible success becomes a target, and the protection against that targeting is documentation, not goodwill. Water decides. That's the reality of drought year agriculture, and it was the reality of 1983 through 1986 in the Central Corn Belt. The farms that survived were not universally the best managed operations, the most modern, or the most capitalized. Some of the best operators lost everything because they had no structural access to water when rainfall failed. Some operations with significant debt survived because they had irrigation wells that kept them productive enough to service their loans. What Raymond had was older, less modern, and less reliable than a pivot system. But it was real. It was senior, and nobody had been paying attention to it. The legal structure of senior water rights is not complicated once you understand it, but it's routinely overlooked in property transactions because it doesn't show up the way a building or a piece of equipment shows up. It's filed in title documents that most buyers and sellers skim past. It doesn't produce anything on its own. It requires infrastructure, maintenance, and the willingness to actually exercise the right, which involves cost and conflict avoidance that most landowners prefer not to engage with. Raymond had engaged with all of it because he had no alternative. That pressure had forced him to activate an asset that had been sitting dormant in the county records for 60 years. By 1989, 6 years after the adjuster had stood in his field and delivered the denial, Raymond's operation looked structurally different from most of what remained in the county. He was farming just over 500 acres, his original ground plus the 2 acquired parcels. He was running a modest but consistent operation with no significant debt service beyond his acquisition loans, which were performing. He had negotiated 2 additional water access agreements with neighboring properties who wanted to draw from the diversion system during critical periods in exchange for annual payments and easement cooperation. Those agreements generated a small but reliable income stream that was, in a meaningful sense, more stable than crop price income because it wasn't weather-dependent in the same way. The insurance reassessment came in 1990. A different carrier, this time approaching Raymond about coverage for his expanded operation, sent an adjuster who spent 2 days on the property. The report that came back classified the farm as having documented irrigation access via senior diversion rights, operational infrastructure, and an established yield history under drought conditions that significantly reduced the carrier's risk profile. The premium came in lower than any Raymond had paid in the previous decade. The coverage offered was broader. The carrier's actuary had done something the 1983 denial had not accounted for. They had looked at what the land could actually do under adverse conditions, not just what it had done in a sequence of baseline years. Policy covers loss. It doesn't create leverage. That's the line that stayed with Raymond when he thought about what 1983 had actually been. The denial had felt catastrophic in the moment, and it was a genuine hardship, a real setback that required real sacrifice and real risk to navigate. But the denial had also forced him to look at his own land with a precision that years of routine operation had not required. He had found something. Not a secret, not a forgotten fortune, just a legal right attached to physical infrastructure that decades of inattention had allowed to sink into the ground. The diversion system had been there the entire time. The rights had been there the entire time. What had been missing was the pressure to use them. He never became the county's largest operation. He was never the story of dramatic triumph that people wanted it to be. What he built was quieter and more durable than that. A farm with a structural advantage that wasn't weather-dependent in the way that purely dryland operations were, anchored by legal rights that predated almost every other active claim on that watershed. In the summer of 1991, during another dry stretch that made farmers nervous enough to watch the sky every morning, Raymond walked his eastern fence line. The corn in his irrigated sections was standing straight. Across the property line, the neighbor's dryland ground was showing stress. Not failure, just early stress, the kind that in a bad year becomes loss. The creek was running lower than usual, but it was running. The head gate held. The water moved through the channel and out into the field with the same indifferent efficiency it had moved with every season since 1983. That was the whole story, if you needed one image. Not a flourishing moment. Not a triumph. Just water moving through a system that someone had been willing to rebuild, through a right that someone had been willing to find, across land that had been paying attention to for a very long time. Water decides. It always has. If you're sitting on a property with an old creek running through it, or an easement you've never looked at twice, or a deed clause that nobody explained when you signed, it might be worth an afternoon in the county records office. The asset that saves an operation usually isn't the one anyone was watching. If this story made you think differently about what's actually in your land documents, drop that in the comments. And if you want to see the next story in this series about a rancher who found a grazing rights clause that outlasted 3 generations of drought, hit subscribe. It's already up.